And so by way of very quick review, a term life policy is a policy that covers you for a certain term. And so if the insured or the person who the policy is for dies within that term, their beneficiaries receive the death benefit. The beneficiaries receive the death benefit. And so then a whole life policy is like having a term policy, but it also has an investment vehicle with it. So you get a death benefit, but you also get an investment and it accumulates cash, okay? So when the insured person dies, it pays the death benefit, but then you also have whatever cash has been generated, okay? And there are several types of whole life policies, variable universal life, there's a whole bunch of them. So if that's something that you're interested in, please reach out to a life insurance professional so that they can talk to you about those options, okay? And then one of the things we've also already talked about are the strategies behind both. So with whole life insurance, people get that policy because they want to have the same premium for the rest of their life. They want to have that premium, lock it in, and pay it for the next 100 years, okay? And then in addition, people like it because they like the idea of building that cash that can be used later, all right? So then the other strategy we talked about was the term life policies, and that one says buy term and invest the difference. So term life policies are typically cheaper than whole life policies. So again, the strategy says buy term and invest the difference. So you take the difference between the cost of one of those term life policies and the cost of the whole life policy and invest that on your own, okay? And so the thought is that you're gonna earn more than you would on the cash value of a whole life policy because you're investing in it and it doesn't include all of the fees and commissions and all of that kind of thing. So those are the two strategies that we talked about before, okay? And so today I want to talk a little bit about how much life insurance you may need and the ways to possibly layer your policies, okay? So if you're the primary breadwinner of your home and you have people counting on you, the rule of thumb says to get a death benefit of 10 to 15 times your annual income. Okay, so if your annual income is $40,000, 10 times that is $400,000 worth of coverage or more. Okay, and so you get the 10 to 15 times as a measure. And the thought process behind that is, so say for instance, that's you make $40,000 a year, you get a $400,000 policy. It's kind of like if you invest that $400,000, if your beneficiaries invest that $400,000 and they invest it in like a mutual fund or something that's paying them 10 to 12% interest, then every year they can pull that $40,000 to use to live off of. And it really wouldn't even much touch the original investment. So that's why you're told to do 10 to 15 times so that they can live on that annual salary year after year, okay? And not have to deal with the financial loss. So another thing that I wanted to cover today, for those of you who work for corporations, many times they'll provide free life insurance for their employees up to a certain amount. Sometimes it would be like a flat amount, like it might be all employees, no matter who you are, no matter what position you're in, all employees get $25,000 worth of free life insurance, okay? But other companies will base it sometimes on your annual salary. So like my job, we get 1.5 times our annual salary in free life insurance. So for instance, in that same scenario, someone making $40,000 per year, they would get the $40,000 plus half of that, which is $20,000, so a total death benefit of $60,000. And these policies that the companies normally provide for free are typically term life policies that they give as one of the part of your benefits package, right? And so these policies stay with you as long as you work for the company. You may be able to get policies for your spouse and your children that you have to pay for with your company. So for instance, I do that with my company. I pay $1.66 per pay period, which is $43.16 per year for $20,000 of coverage each for both of my kids. Okay, so that may be something that's already offered at your company. So that the life insurance that's attached to your job, you have that, right? But I would suggest that you secure a policy outside of your job. Why? Because as we just discussed, those policies are typically enforced as long as you work for those companies, okay? So some do give you the option, maybe when you separate, that you can take the policy with you and then you start making the premium payments. But one thing to check for on that and to do research on is, are they gonna give you the same premium that they were paying, or what is the premium gonna be if you start paying? Because say, for instance, you started at that company when you were really young, but now you've separated from them and you're older, you may have problems getting a affordable policy based on your current age and your current health status, okay? So that's something that you may want to consider. So this is why I suggest having coverage outside of the company, because those policies are enforced no matter where you work, and as long as you pay your premiums, and you will have coverage and they will follow you wherever you go. All right, so let's go on to the next section. It's about mortgage life insurance policies. And so if this is something that you're interested in, do some research on those as well. Two things to consider about the mortgage life insurance policies. Mortgage policies pay off your mortgage in the event of your death. The premium is typically going to stay fixed. It's a term policy where your premium is going to stay fixed. So for instance, if you had a $50 payment on a mortgage life insurance policy, you would pay that $50 until your mortgage is paid off, right? However, the death benefit decreases. And so what that means is, of course, every time you make a mortgage payment, your mortgage payment goes down. So the death benefit is also going to go down based on how much you owe on your mortgage. So the longer you pay, you know, so if you pay your mortgage, say you have a $100,000 mortgage, and in 10 years you got it down to $75,000, well, your death benefit is no longer $100,000, it's now $75,000, okay? And so it's going to keep decreasing until your mortgage is completely paid off. So one school of thought says, well, I'm going to just do that because I want the peace of mind that my family and my children the mortgage will be paid off on the house, and that's like one less thing that they have to worry about. And they'll always have some place to live. That's one school of thought. Another school of thought says, well, if it's decreasing, what if the insured person dies just a couple of months before the mortgage is paid off? Then I'm only going to get this small amount. Well, yes, that's the way that the vehicle is structured, okay? And so like this, with everything, you have to make the choice that's best for you. Because some people will say, well, why would I do that? Why wouldn't I just invest that $50 into something by itself? So like maybe I have the $50 in an investment vehicle, I can just let that grow, and then if I die, they can just use that money to pay off the mortgage. Okay, that's fine. But I'm just giving you the options that are out there for the different life insurance policies, and you can make the decision on your own. Okay, so let's go ahead. And then too, you know what I just thought about? You could actually do that in two ways, because typically if you know about mortgages, you know that you're paying most of the beginning of your mortgage. That's when you pay the most interest, right? You're not really hitting the premium very much. And so that is the case for like at least the first 10 to 15 years. So maybe you just do the mortgage life insurance on the front end, and you have that one, and at the same time you invest $50 in another policy at the same time, so that once the one that you're investing in gets to the balance of where your mortgage is, then you can just get rid of the one that you're paying for. So that's also an option too, okay? All right, so this last type of coverage I want to talk with you about today is accidental death and dismemberment policy. And so an accidental death and dismemberment policy is usually a health insurance or a life insurance rider, and they cover you in the case of unintentional death or dismemberment. Okay, so whoever's the covered person, the insured, if they have an unintentional accidental death or dismemberment, that's where this policy kicks in, okay? So if you have an unintentional death, then it pays the full death benefit, whatever that is. And then if you maybe lose a limb or a finger or something like that, it'll pay out a portion of that benefit so that you're still able to maintain your bills and things of that nature, now having this being disabled in some way, if that, hope that makes sense, okay? And so who would have an accidental death and dismemberment policy? Maybe somebody who has a really dangerous job, or you have a lifestyle that would maybe give you more likelihood to be in an accident or something like that. Maybe you would have an accidental death and dismemberment policy. So if you remember, I said it's a rider. And basically what that means is you attach it to life insurance or health insurance that you already have, okay? So it's attached to it, or it rides along with your normal coverage, okay? I would suggest you always use them in conjunction with or just as a rider, because they only cover sports for very specific circumstances, okay? And so many accidental death and dismemberment policies will not pay a death benefit if you die from a medical procedure, a health-related issue, or like a drug overdose, okay? So again, with anything, do your research, all right? The choices that you have as it relates to life insurance. You have options, and with some research, you can make the choices that are best for you. Maybe you need $400,000 in coverage, okay? And so you buy $200,000 of personal life insurance because you know you have $100,000 of coverage at your job, and you know you already have $100,000 in coverage for your mortgage writer. I call that layering of coverage. Or you know you want $400,000 in coverage, but you can't afford that right now. So you just get maybe $100,000 in coverage because that's what you can afford right now. Or you know that you're disciplined enough, so you get maybe $100,000 worth of coverage, and then you're investing on the side, knowing that that investment is going to grow, and it may grow enough to where you're considered what they call self-insured. You have enough money in all of your assets and investments and things of that nature that if something happened, you have the money you need to be able to pay for your funeral services, okay? So there's all types of options that you have out there. One of the main things that I want you to do is to put a plan together as it relates to this topic also, okay? So just like you put a budget together, just like you put a savings plan together, you put a debt elimination plan together, put a plan together as it relates to life insurance and for the people in your lives, okay? All right. And so quick review. So my mom, one of 10 children, had 3 sisters die within 8 months of each other, and all of them relatively young. Normally, I don't think any of them was older than 65. One of them in their 50s, okay? And so with all of that going on, me and my siblings thought, well, wait a minute, do my parents have life insurance? We knew that if they had life insurance, we were in our early 20s, just starting careers, things of that nature, and we knew that we wouldn't have the money to take care of the expenses. So we asked them, they didn't. We got together and purchased insurance for them. And so, like I told you before, we've got a $10,000 term policy for my mom and a $15,000 term policy for my dad. And every quarter, we got together and I got everybody's money and we paid for that policy, okay? Had a job at Immigration and Naturalization. But because she got that job and she got some insurance coverage, we didn't say, okay, well, we're going to just get rid of the one we have. No. And I'm glad we didn't, because she actually did lose her job at Immigration and Naturalization. And so when she lost her job, the coverage that she had with that company went away too, right? But we still had our little policy that we were paying for, right? And so later, I told you my parents divorced and my mom bought her own house. And when she bought her house, she bought a policy with a mortgage life insurance rider on it. So she just bought that on her own, okay? And so she had layered policies, because later down the road, she got a job at FedEx. So FedEx had a death benefit policy that they paid for their employees. We had our $10,000 term policy for her, and she also had the mortgage insurance rider, okay? So, unfortunately, my mom also suffered an untimely death and died at the age of 59. And it was obviously traumatic for the family, but I'm so grateful to God that we kept that policy that we had for her. And so what we found out later was that at FedEx, she had $25,000 in life insurance coverage from her job, okay? So that $25,000 in life insurance was used for all of her funeral expenses, including the service, the repast. I think there were a few additional expenses that she had, but that $25,000 of coverage that she had paid for the majority of what we needed. And then one thing I can say is, boy, I'm glad she didn't listen to me, because I told her to go ahead and cancel the mortgage insurance rider. Now, the reason I told her that was because she had been struggling with her bills, and so we were trying to find ways for her to decrease her expenses. And so I told her, well, Mom, just drop the coverage. You know, if you're struggling, just go ahead and drop it, okay? And so she always told me that she would, but she never did. And so that mortgage insurance rider paid off almost all of her house for us, okay? And I say almost because there was $3,000 worth of late fees that she had incurred when she had gotten behind and was struggling. And so the mortgage insurance rider would not pay for that. They would only pay, they paid for everything but that. But you know what? We still had that $25,000 from that prior policy, and that paid off that other $3,000 in fees. So, like I said, she had gotten behind, and so that's one thing you need to think about when you're reading for mortgage insurance. For mortgage life insurance, is if you get one of those policies, make sure you read the fine print, because it did not cover those late fees. But like I said, we had layered coverage for her. So the money from FedEx was able to pay for the funeral, and it also paid that $3,000 for that house, okay? And then me and my siblings inherited her house, free and clear of a mortgage. And then that $10,000 policy that we had, we split it between the three of us. Now, why we never thought to increase the coverage more than that, I don't know. But because without the other layers, we may have had a financial impact. It wouldn't have been as much, but we would have had a financial impact without those layers if we had just had that $10,000. So we split that little small policy by three. It wasn't a huge transfer of wealth, but it was a blessing that we had that coverage, right? We were devastated, like I said, obviously, from the loss of my mom, but we didn't have to have a financial loss on top of that, okay? There's no crosswords or fighting between me and my siblings. And going back to the scripture passage, a good person leaves an inheritance to their children's children. We share my mom's free and clear mortgage to this day. And that is a transfer of wealth, okay? And what I love about this is that my mom did not have a lot, but what she did have was transferred onto us, and it's still a blessing to this day. And really quickly, my dad died a few years later. His death was a little more expected. We knew that that was coming, but we still had that little $15,000 term policy, and it paid for all that we needed. There was no huge transfer of wealth, but there was no financial loss, okay? And so I talk about life insurance because, like I tell you, I'm still emotional about the loss of my parents over 9 and 11 years ago. But because we did that plan and we stuck to it and were consistent in our early 20s. We saw the importance of doing it and we stuck to that. Because of that, we didn't have to also suffer a financial loss or a financial death as a result of trying to take care of my mom and dad's funeral arrangements.